Well, ladies and gentlemen, welcome back to the Aon Inside series in Melbourne. It now gives me great pleasure to introduce one of the most favourite sessions that we feature at this event every year. This first session is titled The New Economic Environment with Professor Ian Harper. It's important to note that Ian is not speaking today on behalf of the Reserve Bank of Australia, despite being a board member. Ian, welcome to the Aon Inside series, and over to you.
Well, thank you, Jason. It's wonderful to be back. I enjoy this session every year. I'd much rather be with you in person, as I'm sure many of you would as well. But we have a terrific substitute here, and I look forward to taking you through my presentation, which focuses on some developments in the global economy and then in the local Australian economy. And at the end, hopefully, Jason and I will have some time for some questions from the audience. So let's make a start. I'm grateful for Jason for pointing out that I speak today in my own capacity, not as a member of the board of the Reserve Bank of Australia. Thank you, Jason, for pointing that out. I'd also like to acknowledge my colleagues at Deloitte Access Economics, where I'm still a senior advisor, who've helped me to prepare the slides that I'll be showing to you this morning. So we'll kick off with a bit of global context. And the very first slide I want to show you here is a simple chart of GDP growth by country, as you can see there on the screen before you. And there are, in each case, 4 bars. The light grey bar is the average growth over 10 years to 2018. The darker coloured grey is for 2019. And then you can see forecasts for the full year for 2020 and in yellow for 2021. Just straight GDP growth. Now, I want firstly for you to acknowledge or to observe there the extent, obviously, of the red bars. Note the depth of the downturn. Now, lots of people have compared the current COVID recession with the global financial crisis of 2008 and observed that this dwarfs that by some magnitude, and they're completely right about that point. It's true, basically, that we have not had a downturn of this extent since the 1930s. But it's useful in making that comparison to observe that there are significant differences between what we're experiencing now and what the world and Australia experienced in the 1930s. So these red bars look pretty deep and frightening, and they certainly are deep, there's no doubt about that. But the world economy, the Australian economy, I should say, in the 1930s shrank by 15%. And here you can see there's a forecast for this year. These are Deloitte Access Economics forecasts that we would shrink through the year by about 4% and then recover. You can see the number somewhat larger for the UK and obviously for the Eurozone and other countries mentioned there. But there's nothing like 15% in prospect. So the first point to make is that it's a very deep downturn, but not as deep as the 1930s. The other point to make is that in the 1930s, we were looking at a depression that started in 1929 and arguably went through to the mid of the 1930s. Some people would say that it wasn't over until the onset of the Second World War, which was 10 years later in 1939. I think most economists would say that it reached its depth in about 1932 or 1933. So it took years. Now, in prospect, you'll see these charts, and I'll draw your attention to the little bar over there for the United States in a moment. But no one is predicting that this downturn will last for years. The other feature of this downturn is that it's sharp on the downward direction and then sharp as it recovers. And there's a reason for that I'll explain to you in a minute. Before I go there, though, you'll notice the bar for the United States. You'll see that all the countries that are mentioned there, my colleagues at Deloitte Access Economics are still forecasting that the US will be in negative growth for 2021. Now, that's off the back of, as most people would know, still growing numbers of COVID cases in the United States. Now, it may be the case that the same thing happens, or at least they're not as tall. The orange bars or yellow bars aren't as tall for the UK and the Eurozone because, as we well know, it looks like there are further lockdowns in progress in those countries as well. So these numbers don't take that into account. They were drawn up when we knew about what was happening in the United States. What's happening in the UK and in the Eurozone is sort of breaking news, if you like. So these numbers may be a bit optimistic. But I want to make this point to you. The economic impact of the COVID pandemic is essentially, as economists say, as a result of supply-side restrictions. So this is a supply-side driven downturn. Yeah, well, so what, you might say? Well, the difference is this, that when the supply restriction is removed, the economy recovers very, very quickly. That's the difference between a supply-side driven recession and a demand-side driven recession. Now, in the 1930s, the Great Depression was demand-side. So it started with a financial crisis, which then fed into unemployment and lack of consumption, lack of wealth, people going bankrupt, people losing their jobs, and around you go. Of course, in the 1930s, there was no demand-side stimulus. We hadn't basically invented monetary policy and fiscal policy. And so the Great Depression was extremely deep and nasty for those two reasons. That were demand-side. It originated on the demand side, starting with a financial crisis, whereas this is a supply-side phenomenon. So once the supply-side restrictions are lifted, the economy recovers quite quickly. We can see that happening at home. When I get to the Australian numbers, I'll take you through that in more detail. But I think it's an important distinction to make. Related to that is the fact that this crisis, economic crisis, did not begin with a financial crisis. So the other great sort of mercy of what we're experiencing, certainly here in Australia, but basically around the world, is that there is no financial crisis accompanying this economic crisis. So normally it goes financial collapse or financial crisis, as in 1929, followed rapidly by a banking crisis. You can see the same pattern happened in 2008. And then you get the economic crisis that comes after that. Well, in 2008, that was a bit of a fizzer, partly because of, again, government support. In the 1930s, it was not a fizzer at all. It went all the way through. But this time, no financial crisis. The financial system is in rude health. The banks are well capitalized. Financial volatility indices are all way down. The prices of financial securities, of course, interest rates, yields, spreads, whatever you want to pick, they're all at historic lows. Funds are flowing easily, and there are no bank collapses. So the financial system is helping to support us through this whole process, admittedly, itself supported by the central banks, but all of that is occurring against the backdrop of a very high degree of financial security. Now, what that means then is that when the supply side restrictions lift, you've got a banking system, a financial system that's ready to run with whatever's required to build the demand side again. And then finally, what you've got is a very high degree of fiscal and monetary policy support in this downturn, in this recession, certainly compared to the Great Depression of the 1930s. So first point to make is, yes, this is a deep one. It's deeper than anything we've seen since the 1930s, but it's likely to recover much quicker once we get the pandemic under control, because it's essentially driven by the supply side, not the demand side. In the meantime, the financial system is safe and sound, mostly as a result of all the repair work that was done post the GFC, it has to be said, but it was done, and the financial system is sound. And then the third point, of course, is that there is massive fiscal and monetary stimulus, both here in Australia and around the world, so that once the supply side restrictions are removed and the demand side is ready to fly, there's plenty of support to ensure that the demand side makes a rapid recovery. So all of those things distinguish our experience from the 1930s, and will also help to explain the shape of the charts that I'm going to show you. That's why economists talk about a V-shaped recession or V-shaped recovery. Sharp down, sharp up, and the reasons are the ones I've given you. Now, looking again at this chart, yeah, the difference there is, as I say, the United States, but I've explained to you why that's true. So the gold bars for the Eurozone and the United Kingdom may come down a little bit as the wave takes hold there in the UK. And in Australia, we may in fact have a slightly higher gold bar as we recover as well. Let me show you now this next chart, which makes the point that I've been making. This is the supply side of the economy. This is industrial production. And you can see the impact, the forecast impact of the supply side restrictions associated with the health measures to control the pandemic, rapidly restrict the rate of growth of industrial production. That shrinks right the way around the world, even in China, which had a relatively speaking, a relatively mild experience with the pandemic. They got onto it particularly quickly. And then a recovery in forecast quite rapidly. With the US, as you can see here, even a little weaker than the others, but a rapid recovery in industrial production as the supply side recovers. Can I also make the point that this same sort of set of phenomena show you, and here's an example in a way, the Chinese is a nice example of that, this notion that somehow there's a trade-off between lives and livelihoods is not supported by the data. What the data show you are that those countries that get onto managing the pandemic fastest are the countries that have the least economic disruption. And those countries that essentially allow this pandemic to run its course, don't get involved, turn their back on it, find that the economic fallout is substantially greater than that in other countries. And I guess Exhibit A in this instance would be the United States of that phenomenon. The former phenomenon, namely getting onto it quickly and doing something about it, you can see the impact here in China. In Australia, we're at the China end of that particular spectrum, as you'd know. Our governments, particularly here in Victoria, but right around the country, have acted quite quickly, as a result of which we've had a relatively mild, notwithstanding the second wave in Victoria, a relatively mild experience by international comparison, and as that's also been true of the economic downturn here. So those two things go together. It's not as if there's some sort of trade-off. Let me now move to the next slide, I've got a couple of slides here which show you the extent of policy support for the economic downturn. So we've got monetary policy basically at full noise in all of the countries that you can see there, and also the forecasts are for that degree of monetary support. These are short-term interest rates, as you can see, for the different countries, but that level of monetary policy support is forecast to extend right out into the foreseeable future. So you've got monetary policy essentially at full pelt. Here and there you've got some slight differences in the way the policies are being administered, with a comparison of interest rate movements versus central banks expanding balance sheets. But whichever way you look at it, what the market is essentially telling you is that interest rates are very close to zero, at zero, or in some cases beneath zero. Monetary policy at full noise, as I say. Same is true of fiscal policy. You've got substantial support across the countries that are mentioned in this chart. These are simply measuring the degree of fiscal spending as a proportion of GDP. Australia is not at the top of that list, notwithstanding the fact that we've had significant expenditure and budget deficits at record levels and all the rest. It is still true that the expenditure that's occurred here in Australia fiscally to support the COVID recession is not as great as that elsewhere in the world. So let me now move from the global economy to our own context here in Australia. So same thing, we've been dealing with the same fallout from health measures. So the sequence is pandemic breaks, governments restrict the supply side of the economy in the interests of essentially preventing movement of people and communication of the virus from person to person. So particularly affected, as we know, are the services sector, but not exclusively, big manufacturing plants, abattoirs, that type of thing. We'll see in a moment other parts of the economy less affected according to how capital intensive they are. And that is to say, we don't have to worry too much about people moving around. I'll come to that. But here's the pattern for the economy as a whole for us in Australia. Again, you'll see this chart is just breaking up the different components of gross domestic product. The light grey is for 2019, the red bars 2020 forecast, and the yellow or gold bars 2021 forecast. What I want you to see is the same pattern, right? All the red bars off to the left for 2020, negative, and then swinging rapidly in most cases 2021 across to the right. So there's your V shape. The economy slows, right? In fact, shrinks and then rapidly recovers as the supply side restrictions are removed. Remember, those supply side restrictions are against the backdrop of historic monetary and fiscal stimulus, right? So sometimes I use the analogy, I'm not a medical person, but I think the analogy, works for most people, is like a tourniquet, right? The economy, if you like, the body economic was bitten by a snake, right? Someone has applied a tourniquet to prevent the poison from infecting the entire body. So we do that. And that does exactly for the body what it does for the economy. It restricts circulation, reduces the growth of GDP in the interest of preventing the spread of this disease. Now, in the meantime, you can administer as much adrenaline as you like. You won't necessarily help the patient because the blood circulation is prevented. But once the tourniquet is released, and as a sidebar, you have to release the tourniquet, reasonably quickly. You can't leave it there too long, otherwise you do a whole lot of damage to the body economic. That's a sort of sideline. But once you release the tourniquet, the blood rushes back into the affected limb very quickly. And if there are additional medications, like monetary and fiscal policy, if you like, adrenaline or something has been administered to the patient, then whoosh, the economic activity or vital activity of the patient rapidly recovers. That's what's happening here. That's what you can see before your eyes. As the supply side restriction moves away, these monetary and fiscal stimuli sitting in the background suddenly come into their own, and you'll get a quite rapid economic recovery. Here you can see on the right-hand side of the chart, if you start at the top, there's your turnaround in GDP growth from the red to the gold. Import growth, which has been so low that we've had historic current account surpluses. Here we go. We're running across now, once again, to strong import growth. Exports recover, as you can see in the next chart down. Public capital expenditure recovers. Certainly even business capital expenditure we're expecting to recover. And then down the bottom here, you can see public consumption, which has obviously been supporting us through this recovery, coming off a little bit compared to the red. This is as we start to wind back things like JobKeeper. And then down the bottom is private consumption, which is nearly 2/3 of the economy. So there's your red. The economy is dead in the water because consumption is way, way down, and that recovers quickly in forecast on the right-hand side of the chart. So you can see the pattern there, a very strong V-shaped recovery in forecast. This next chart shows you what that looks like when you map it onto unemployment, wages growth, and inflation. Again, the forecast to the right-hand side of the chart, to the right-hand side of this middle bar are forecasts, to the left-hand side are actual data. Just focus on the top line there, the gold line, which is the unemployment rate. Now, these are Deloitte Access Economics forecasts. Here you can see the little kink there in that gold line, as we've had a recent downtick, as you know, in the unemployment rate, but JobKeeper has not yet been switched off. When we switch off JobKeeper, we expect the measured number of unemployed. So those folk who aren't doing anything, being paid under JobKeeper but are sitting on the books, they're not technically unemployed, as people often point out. Once the JobKeeper finishes, then many of those folk will simply be back looking for work, hence the increase in the unemployment rate. That's the bad news. The good news is that it looks like it won't even crack 9% in forecast and then start trailing off. Regrettably, unemployment is still expected to be quite high in 3 years' time, but nothing like the Great Depression. In the Great Depression, friends, unemployment was 20%, right? So nothing like that. But nevertheless, unemployment is a serious problem, and it will rise as JobKeeper comes off. That's inevitable. You can see that'll produce further downward pressure on wages, which is the blue line, and then that'll gradually creep up as the economy recovers. On the right-hand side, you can see the impact on inflation. We've had a quarter of negative inflation growth right down the bottom there, you can see. There'll be a spike up as various administered prices, which have been set at zero, like childcare and rent, holidays, and that type of thing. As all those come off, you'll get a sudden spike up in CPI growth, which will then settle back down again to trend. But we'll be way below the Reserve Bank's target range for some years to come, as the Governor of the Reserve Bank points out. So their forecasts there. Let me now, here's a chart showing you what monetary policy has been doing locally. Right the way down here on the right-hand side, you'll see what the market thinks is going to happen next. You'll understand that I'm not going to make any comment about that. But the market thinks we're going to lower the cash rate even further. And the same thing, of course, that would happen would affect Treasury bonds further out along the yield curve. Well, whether that happens or whether it doesn't, there is no doubt that the degree of monetary stimulus that we're experiencing here is clearly of historic proportions. That chart goes back 20 years, but we've not seen anything like this. You can go back as far as you like. we've got monetary policy again, as I say here, at full noise or virtually at full noise. Now, this is a chart I was talking to you about that shows the impact of the COVID recession and the recovery across the different industries in the economy. And broadly speaking, as you go from left to right, you can see we become more services intensive to the right of the chart, where there are more people involved, more people movement or aggregation or congregation, and therefore the impact of the supply restrictions is a whole lot worse. And when they're released, the recovery is a whole lot stronger. And not all services industries. Here's the manufacturing sector. You can see manufacturing affected by virtue of the fact that factories had to operate with fewer people, fewer shifts and that type of thing. But the most severely affected have been on the right of the chart: accommodation, food services, transport, storage and so forth. Just one other thing to draw your attention to on the left of the chart is the mining sector. See how mining, which is 75% effectively of our exports, well, they're not mining, but mining's a very high proportion of that, but they're also agricultural exports. But whether you take mining or agriculture, which is a bit further along, neither of those have been particularly severely affected because most of the commodities are bulk exports. And that's very capital intensive, not many people involved. And on the ships themselves, few people, and they're at sea for 2 weeks, so they can self-quarantine. So our mining sector has been virtually unaffected. The agricultural sector more affected by climate movements and seasonal patterns than by the pandemic. And you can see a recovery there if you look closely at the farm sector chart, which is mostly to do with El Nino rather than with a release of the COVID restrictions. So same pattern, but now distributed differently across the economy, favouring the services sector. Those sectors that have been heavily affected will stage the greatest recovery. Now, I want to finish with 3 scenarios that my colleagues at Deloitte Access Economics prepared. Now, these aren't forecasts, friends. These are scenarios. They were prepared 3 or 4 months ago at the height of the pandemic to give us some sense of what the range of possible outcomes might be. So there's no need to focus too much on the actual numbers. I just want to give you a sense of the sort of breadth of what we thought could happen, and then say a little bit about where I think we are now. So there was an optimistic scenario, optimistic and a base and a pessimistic, the usual story. And here you can see the optimistic scenario saying it'll be not particularly deep as a recession, looking at the gold chart there with GDP. There'll be a quick recovery, and the recovery would begin around about now, right? In the second half of the year, around about September or October, a quick recovery, and then we'd come back to normal relatively quickly. That same pattern, unemployment, the bottom right-hand side of the chart, the blue line, saying that we'd peak at a little over 8%, as you can see in that chart, and up in the top right-hand corner with inflation, there'd be a period of negative inflation, and then we'd recover. That's the optimistic scenario. The next chart was the base case. Well, the difference there, bottom left-hand corner in the yellow, a deeper downturn, sharper a recovery, but one that takes a little longer, doesn't start until the second half of next year. On unemployment, higher unemployment, peaking at about 10. And the same pattern with inflation, but we'd spend longer with negative inflation in the base case scenario. And the third scenario, the pessimistic scenario, as you might imagine, was built on the basis that we would have a second lockdown nationally, not just in Victoria, but nationally, right? And as you can imagine, that would really have knocked us around. Here you've got minus 15% nearly, or minus 14% in terms of shrinking of the economy, the gold or yellow line, and a recovery which takes a lot longer to get going. It's still fairly V-shaped, but you can see it spread out over a lengthier period of time. We wouldn't start returning to positive growth until the second half of next year in that scenario. And then similarly, you can see on the right-hand side over here, the blue line, unemployment topping 10% and staying up there. And the red line, inflation, down to the negatives, up and then down again, because of the deep recession that would ensue. The last chart simply asks this question. It says, well, all right, of those 3 scenarios, how long would it take to get back to where we otherwise would have been? The black line across the top there is 100%. That shows you the forecast of where we otherwise would have been. It's just a forecast, but it shows you the baseline, if you like, of where we otherwise would have been. You can see the optimistic scenario in yellow would say that we're back to basically where we would have been by 2023. And then the middle line, the red line, we still would not be back to where we were by the end of 2023, and it'd probably take 2 or 3 years more. And you can see the bottom line there, the grey line, the pessimistic scenario, showing that we would be well below where we otherwise would have been into the foreseeable future. That may have taken 5, 6, 7, 8 years for us to recover. And the last comment, Jason, is simply to point out that before the second lockdown in Victoria, I thought we were clearly travelling between the red line and the yellow line. Right? We were between the base and the optimistic. Then with the lockdown, and maybe that was just because I was locked down here in Victoria, I thought, oh boy, right, we're now tracking below the red towards the grey line. We're headed off towards the pessimistic. But today, right, tonight, as you know, we'll be free again. And in the meantime, the rest of the country's been getting on with its life, as it pointedly reminds us down here in Victoria. Yes, you're getting on with life. So nationally, I would say that we're travelling between the red and the gold line again, which is great news. When could we be back where we otherwise would have been? It won't be as early as 2023. That's too optimistic. But I would have thought that thinking 2024, 2025 is looking fine. Now that's still, a 4 or 5 year period for us to get back to where we otherwise would have been. But a whole lot less than was true of the Great Depression, and a whole lot less than would have been the case if we'd done nothing about the pandemic and just let it go, or done nothing in the way of massive support that the government's provided through fiscal and monetary policy. So if I do say so myself, I think we can be pretty proud of our governments and public institutions, and frankly, proud of the Australian public for having managed this a whole lot better than has been the case elsewhere in the world. We're fortunate, we're an island, but these things can go pear-shaped very quickly, as we've seen here in Victoria. So there it is, Jace, a mixture of good news and bad news, but I think we finish on a good news note.
That's great. Thank you so much, Ian, for that wonderful overview of where the economy is, and in particular the scenarios. And also really good to hear, Ian, that your personal views, that you feel that the optimistic scenario is starting to really show form, which is great to hear. We do have a whole range of questions from the audience, but I'm not going to have time to ask all of them. But I might ask a couple, if I may, Ian. And the first one that we got in here, which was a good one, was really around governments, and how long can governments keep drawing on the QE, the quantitative easing well? And given that we're already in uncharted waters, what are the risks to society? Do you have a view on that, Ian?
Well, on monetary policy, as far as the central bank is concerned, the technical answer, and I emphasise the technical answer as opposed to what we might actually do. The technical answer is that the Reserve Bank can continue to buy securities as long as it likes. It just keeps, as people say, printing money. Well, effectively, it just buys these securities and expands its balance sheet. And there's no limit to that, technically. When the market eventually responds, of course, it can send prices haywire in financial markets and for goods and services. We know that. So you've got to be very careful with it. But there's no technical limit. The Reserve Bank can support as long as it's like. So the idea the Reserve Bank runs out of ammunition, that's false. As far as fiscal policy is concerned, the government can continue to spend money too, as long as the markets will absorb the paper. And at the moment, Jason, the government's attempts to sell its securities, each of these auctions is oversubscribed, in some cases by as much as 50%. So people are throwing money at the Australian government, and even with the expenditure which has been presently gazetted, we have debt forecasts that are well below debt to GDP ratios that are experienced elsewhere in the world. And the notion that somehow or other this is irresponsible, again, I think is false. And we have plenty of capacity if we want to borrow more. Hopefully we don't have to do too much more, but if we had to, we have the capacity to do that.
Great. Thank you, Ian. And a final question here, which is, I think, a very relevant one. Does the economic recovery assume international tourism returns to normal in 2021? And does it play a significant role, Ian?
It doesn't assume that. It assumes that we will have the border opened by the middle of next year. So there would be, of course, a recovery of tourism as we get going, but it's going to take quite some time, as people in this audience would well realise, for folk to be comfortable flying on aircraft again. So with due respect to the the airline industry, it's going to take a bit of time there. But I would point out that, our services exports are important, but the services exports are 25% of exports, 25% of exports, right? And that includes education. So tourism and education are the big ones, but that's 25% of exports. And exports are 20% of GDP. So to be frank, our exports will recover in other areas, right? And right. Exports of commodities haven't been affected much at all. So it's important, Jason. Of course, it's good to have, right? But we're experiencing a recovery anyway through the domestic economy. And, there you go. 80% of the economy is essentially domestic. And that will produce jobs and growth for us. Not as strong as it would be if we had our exports and imports going. One final point on tourism. We're a net importer of tourism services. So Australians spend more money out of the country than foreigners do in the country. So the closed border has actually improved our trade balance when it comes to tourism services. Not that I'm recommending we keep it closed, but it hasn't done the economy as much harm as people think.
Great. Thank you. Thank you, Ian. Well, Ian, as always, it's always a great pleasure to have you present at our Aon Insight series. It really has become one of the cornerstone components of the event every year. Thank you so much once again for providing your economic update to our audience, and we look forward to seeing you back again next year. Thank you very much, Ian.
Thanks, Jason. I really appreciate it. Thanks, folks.
Thank you.